Hi guys, this is your favorite YouTuber again, Dami Salari, and you're watching DS Learning Finance. Whoa. This week's video is a very important one. Why? Because it tells you the things that can cause the share price to fluctuate up and down. And basically, if you understand this, the T, then you can pretty much be successful in any investment that you partake in. Want to find out what they are? You know what to do. Keep watching. Now you notice majority of these reasons actually fall within our sort of human power, and it's either down to human error, human perception, or just the way the economy is going, which is obviously dependent on humans in the long run as well. Our first point is execs. This is where you have investors that follow what the executives do of the company. It's the whole belief, like, follow the leader, in the sense of obviously the exec has the best intentions of the company in mind, so whatever they're doing, they have the best interest in the company. If they're selling their stocks, then that means that the company's not really looking good. On the flip side, if they are buying more stocks, then that means there could potentially be something good over the horizon, and you have investors blindly following that. The thing about following that is you can't tell what's the reason behind that investor buying or selling their shares. Let me give you an example. If the executive wanted to buy £1 million worth of shares of ABC stocks, in respect of the actual £100 million worth of ABC stocks that they already own, then it's pretty much negligible because it's only like 1%. On the flip side, if that same executive still had that 100 million worth of ABC stocks, they still had that 100 million, cool, but yet they're willing to sell 60 million worth of that, then that's a big red sign, because they're literally willing to sell majority of their share ownership. And that's the point I'm trying to hit at. It's not how much the executives buy and sell their shares, it's how much in proportion to what they already own in terms of number of shares. The second sort of reason that can cause the share price to fluctuate up and down is dividends. Now, you guys should know what dividends is about. It's basically free money that a company gives you for saying thanks for investing in us. That's what dividends is. So in the investing world, you can imagine dividends are very important, and people keep a keen eye on dividends. With that said, you have an important date, and that's called the ex-dividend date, and this is where everyone that owns a share prior to that date, before that date, gets dividends paid to them, so free money paid to them. And you can imagine it's crazy before then and it's calm after. If you are owner on the ex-dividend date, then it is your seller who sold those stocks to you, those shares to you. They're the person who actually gets dividend. So you'll tend to find that before the dividend date, i.e. before payment of dividends, the share price will go up, understandably so, because everyone's thinking, yes, dividends, we're going to get the dividends for this year. And then after, once the dividends are paid out, no one really cares about the stock anymore. So people tend to the share price tends to go down. And that's basically how dividends affect a stock price. A type of reason behind the share price fluctuating up and down is due to the market makers. It's called tree shaking. So what the market makers do is they dictate the price of a share. So if they want a share to be £10, it can be it will be £10. If they want a share to be £5, it will be £5. So they dictate the price. So what happens is you get huge orders. If, for example, a wealthy person wants to buy 1,000 shares of ABC, so what they do is they go to market makers and they tell them, look, I want 1,000 shares of ABC. Obviously that's a lot of shares. When there's not enough sellers for that 1,000 worth number of shares of ABC stocks, when there's not enough people that accumulates to 1,000 shares, they actually shake the price. So you can imagine, it's a good analogy is actually tree shaking. So imagine grabbing a tree, a thin tree, and then shaking it and rustling it off. So what it does is it allows market makers to sort of get easy pickings from basically insecure investors. So investors that aren't too sure about a stock, investors that aren't too sure about the research that they've done, investors that don't know what's going on with that particular company, they cause them to sort of fear and therefore exit at a loss. And now because they've exited at a loss, there's now room for that 1,000 order of shares, and obviously that makes the rich man really happy. So that's what market makers do. So you'll notice when it comes to that, those sort of cases, there tends to be no sort of news about the company. There'll be no sort of reason behind anything. Why is the price going down? But the reason why is because of the market makers. This is a big one you've got to watch out for, guys. What they like to do is they like to decrease the share price bit by bit. So it makes you think, okay, this share price is going from 90p to 89p to 88p to 87p. So it makes you think, okay, cool, I can quickly leave now and not lose that much money. So it causes you to be sloppy and causes you to be urgent, and it's that sort of naivety that makes you slip up, because yes, you haven't lost as much as you could have, but you've just completely made a gap for that person to fit in that order. So what I would say is, when it comes to that sort of situation and you see your share price of your stock decreasing penny by penny, and you've done your research, you've seen at the latest news there seems to be no information, honestly, just get up and leave the desk. Do not leave I don't mean like leave the bit, I mean like leave the desk, because it is 99% of the time the market makers doing the tree shake. Reason number 4 is tipsters and bulletin boards. This is from word of mouth. So people who claim to have inside knowledge of what's going on in the stock. Oh, the stock's just found oil, so they're going to be like billionaires in like a year's time. Those sort of people. Remember that saying, if it's too good to be true, then it is too good to be true. You also get special people. You also get special people on the bulletin boards that claim to know, or gurus saying that yes, I can see the future. I can see the future. This stock is going to rise. You get people like that. Don't fall for their traps, please. Yeah, I actually did a video about this, guys. So yeah, watch my previous video. It's about how you can't have friends in the stock market. I'll leave a link in the description box below. But yeah, tipsters, bulletin boards, gurus, basically word of mouth. Don't trust anyone. There's 4.5, and it's kind of like a step up from the tipsters and the bulletin board people, the gurus. You have professional people who make recommendations. So like, this is brokers that make recommendations. Like I said previously, you've got to fend for yourself, think for yourself, and believe in yourself. No one can tell you, no one should be spoon-feeding you in the market, to be honest. So that's how I feel about that. Yes, you can use them for like inspiration, you can use them for direction, but that doesn't mean that what they say is the holy grail. Doesn't mean that what they say you blindly follow. No, that's just pointed you in the right direction, and then you have to actually take that path further to actually find the end goal. Number 5 is surprise events. Now this one is really hard to predict, because obviously you don't know if something's going to happen. You don't know when something happens until it happens. So this includes stuff like terrorists, this includes stuff like deaths. It's basically anything really that affects a company's profitability and is difficult to predict. The 6th reason is due to economic news. Now this is anything that is produced, any news that is produced that affects a company. A good example is, say the price of metal was to go down, price of gold was to go down. All the gold mining companies, all the jewelry companies, those guys will lose. They'll go down in terms of price. They'll go down in terms of profit, simply because the price of gold is worthless. Takeovers and mergers. Now I actually did a video about this, guys. I'll put it in the link description below as well. This is about takeovers and mergers. Quick sum up: takeover occurs when one company wants to acquire another company. Obviously that bidder company has to be richer than that company that is going to get bought. That's what a takeover is. And a merger is two companies that are on equal footing that join together. So Coke and Pepsi join together, that would be a perfect merge. ExxonMobil's actually a merge as well. But yeah, the general mood of it is that you want to be in the company that's being bought. because the general price of that share is valued as more, because now that bidder company wants to buy that share. So not only are they putting pressure on that share, but their investors are putting pressure on that share. Number 8 is rights issued shares. This is shares that are given specifically to already existing shareholders first. So if you're a shareholder in company ABC, because you are an already existing shareholder, you therefore get the rights issue share. And the really good thing about these is that they come at a discounted price. So if originally a normal original fresh share costs like £10 per share to buy for ABC, then you could get a rights issued with a bit of a discount. So I don't know, if it was 30% off, you would have to just pay £7, and automatically you know you're already in profit. From an increased amount of supply, you can tell that the price will go down because there's simply more of it. But throw this curveball at you guys: if all of the already existing shareholders were to buy the rights issued shares, then that would mean that the share price would be likely to go up. The reason being is because the only people that have the shares are the people that have owned it previously. So even the new rights issued shares, those shareholders have not changed, and therefore people who are from the outside that actually want to get in, they'll value that share price more. They'll value that share more, and therefore the price will go. Whether it's human manipulation or human mistakes, or just simply whether it's human perception. Understanding these occurrences in the stock market is the science behind it. But actually being able to predict how investors, other investors, your peers will behave in regards to this, now that's the art. And with that said guys, that's the end of my video. I know you enjoyed it. Don't worry, there's more coming. You know I'm too consistent for this. But yeah, keep watching, and don't forget to like, subscribe and share. LSS DS Learning Finance. Whoa, see ya.